So we are now being warned about the next potential banking crisis. And this is why some experts are telling us to get out now. Take your money and run. Now, I'm going to address what is being said, what the CEO of JPMorgan is now telling us, because he sees more trouble ahead. I will address what's going on there in just a second. All I ask is if you enjoy these daily updates, do me a favor, go ahead and hit that like button. Now, here's where things are at this moment. The U.S. economy is powered by consumer spending, which is fine as long as we continue to have the ability to spend. This is where many businesses, many individuals, and large CEOs are seeing some issues. Because this is where we could see more problems. Because according to the CEO of JPMorgan, Jamie Dimon, he says that right now we are spending like drunken sailors, which obviously that's not a good look. That's not what we're going for. He also says that he wouldn't be a big buyer of a bank and sounds the alarm on the economy. Now, why would he do this? Well, he says a lot of different things, but he says these things because he sees the risks in our economy at its current state. Now, let's address some of these risks really quick. First off, we still have inflation over 3%. I don't know if it's going to go down. We will find out very soon. We know home prices, they're still at record highs all across the country, and some real estate experts say they may not come down. And the reason for that is because we are continuing to see a shortage of housing, but at the same time, we've seen interest rates go up, up over 7%. But at the same time, housing prices have not come down. They've stayed flat. So the problem that we could see is if rates come down, prices are going to go up. And that could be another huge issue for lower and middle income households. We also know the U.S. government is currently fighting over fiscal spending and additional deficits. We don't know if the U.S. government is going to be funded for fiscal year 2024 yet. We're going to find out over the next few weeks because the U.S. Congress has until September 30th to get a deal done. We also know our monetary policy is turning into a massive issue, and the Fed could still raise rates in the next couple of weeks. Again, we're going to find out all this stuff in September. Now, everybody's pointed out the economy is still strong. I got a message from somebody just the other day, and they were saying that the economy is still strong, unemployment is low, we have ample job openings, and why can't we continue to spend? Well, we can't continue to spend because our money is somewhat tied up. It's tied up into credit card debt. It's tied up into just overall expenses. All right? A car that you couldn't afford 2 years ago, but you decided to buy it. A home that you probably knew, it's a little bit expensive, but what other option do I have? I need a place to live. So we are now struggling. This is where consumers will stop spending. But it's what Jamie Dimon said the other day. He had this to say, and I quote, "To say the consumer is strong today, meaning you are going to have a booming environment for years, is a huge mistake." And it's true. You think about it. Okay, great. Consumers continue to spend money today. We will have a booming economy for the next, 6 months. Maybe. But it doesn't mean just because we're continuing to spend money today, we're going to have money in the next year, 2 years, 3 years. Doesn't mean that's going to happen. That's why he's saying it's potentially a huge mistake. But what is scary about what he is saying is that he knows his stuff. And I've said this before. When the CEO of a company comes out, you listen. Now, when the CEO of the largest bank comes forward, he knows his numbers. He knows his numbers better than anybody else does. He probably has more information than the Federal Reserve as to how far consumers can spend or what their current behavior is. He knows this. Okay, he gets these updates probably on a daily basis. Now, when the CEO of a bank is saying that he wouldn't be a buyer, that means he isn't certain about the future either. So if the CEO of the largest bank would not want to come out and buy another bank, there has to be a reason for this. And if other banks need somebody to acquire them, that means they're going under. They're not selling right now because they're just making so much money hand over fist. No, it's because they're struggling. Now, some of the reasons why he would not want to be a buyer, according to his recent statements, for one, it's because of recently proposed capital rules on lenders, where all lenders that have over $100 billion in assets, you'd be required to hold 30% more in capital than a European lender. So according to Jamie Dimon, he says that would dampen lending and economic growth. And so if we are now requiring banks to hold even more capital, they're only doing so because of an insurance purpose. They want to ensure that in the event that, for one, they're not lending any money, which means they're not making any money, and the economy slows down, well, you want to make sure your bank doesn't go under. And you can't do that if you don't have money. But if all this money is tied up and is just sitting there and they can't use this to make more money, this would actually hinder economic growth. So that's one of the issues. The other issue that Jamie Dimon does talk about is that right now we still have a war going on in Ukraine, which the Biden administration is currently attempting to secure another $23 billion for. So if we see additional funding go out, there's now more upward pressure on inflation. And we could see that come back very soon. But here is why this is such a terrible time for banking and why CEOs are being very cautious. The Treasury, and you probably heard me talk about this in the spring, the Treasury came out and said that they would need to put the responsibility on the banks. If a bank goes under, it has to be other banks that take on the responsibility. It shouldn't be the American taxpayers. Now, what they called for and what they've talked about is raising fees, the FDIC insurance fees, so that consumers don't feel the need to pull their money out of the bank. But the big banks are now starting to hate this idea. The banks, they haven't made any changes. And in fact, many experts believe that the next banking crisis is going to be what takes down the markets. It's going to be bigger than what happened in the spring, and we are going to see several big banks go under. Now, the larger banks have been somewhat questioning the decisions that could be made. They are concerned, and they're starting to complain about potentially having to hold more capital in the event of a crisis. But what nobody seems to be talking about is how interest rates are impacting commercial mortgage-backed securities, or CMBS. Okay? According to experts, they say this is likely going to be what causes the next banking crisis. I want to show you something. Look at this. This is just from yesterday. This thing says CMBS delinquency rate has jumped 56% since January. 56%. And in this article also goes on to say that 62% of newly delinquent loans are a result of maturity defaults and refinancing challenges. Think about that for a second. Why would somebody want to go and pretty much renew their lease on a building, right? Try to go and secure this building that they don't have workers in anymore. Okay? Because these businesses have decided to go and work remotely, where you can work from home. You don't have to go into the office. You can work from home. You can take phone calls. You can do Zoom meetings. You can do everything you need to do at home. You can do it from a Starbucks. You can do it from the comfort of your couch using your phone. Why would they go and try to keep an office building? So this is why we're seeing defaults. This is also why we're also seeing challenges when it comes to refinancing a building. Think about it. The rates have gone up. The values of these properties, depending on when they got it, well, chances are the value's gone up, right? Rates have gone up, everything's more expensive, and yet these companies don't really need the building. So let's just give it back to the banks. This is why this is saying that the CMBS delinquency rate has jumped 56% since January. It's gone up. Because why do people want to keep this building that is probably vacant? Now, I'm not here to tell you that you need to pull your money out of the banks because the banks are all going to go under, you're going to be screwed, and everybody is just going to be in disarray. Okay? I'm not here to tell you to take your money out of the bank and put it in the stock market, go buy real estate and put it into gold and silver and buy cryptocurrencies and go buy NFTs. I'm not here to tell you any of that. What I'm here to tell you is you need to be careful. Keeping all your money in one bank is not a smart move. You want to stay diversified. Put your money in different banks. In a bank, put it in a credit union. Okay, keep some money in cash, buy some gold, buy some silver, have some real estate. Okay, have some bonds, right? Have some mutual funds. Again, diversity. Okay, this isn't financial advice. Okay, because you can do whatever you want. But what I'm here to tell you is, if you are concerned about these banks, you should be. Because when the CEO of JPMorgan Chase is saying that he sees trouble ahead, you need to listen. And the other thing is, if you have all your money in one bank, I'd recommend you get out now. Get out. Don't keep your money in one bank. Diversify. Put your money in different banks. Just in case one of them goes under, you will still have your money there that you can use. Because again, even though we are hopefully all FDIC insured, it's only for the first $250,000, and then, well, you may lose it. So, if you guys have any questions regarding what is going on at this time, please ask your questions down in the comment section below. Again, thank you guys for watching. Consider subscribing, and I'll see you guys on the next one.